The EBIT margin is a financial ratio used to assess a company's profitability by showing the percentage of revenue that remains after subtracting operating expenses, but before accounting for interest and taxes. It reflects the efficiency with which a company converts revenue into operating profit. This ratio is particularly useful for comparing companies within the same industry because it focuses on core business operations without the influence of financing and tax structures. Compared to other profitability ratios, such as the net profit margin, EBIT margin isolates the impact of operating activities from non-operating costs. EBIT margin. The EBIT margin is calculated by dividing the earnings before interest and taxes, EBIT, by total revenue, then multiplying the result by 100 to get a percentage. Essentially, this ratio shows what portion of each dollar of revenue remains as operating profit. Example. For example, if a company generates $1 million in revenue and has EBIT of $200,000, the EBIT margin is found by dividing $200,000 by $1 million, which equals 0.2. Multiplying this result by 100 gives an EBIT margin of 20%. This means that 20% of the company's revenue is retained as operating profit before interest and taxes. Low EBIT margin. A low EBIT margin indicates that a smaller percentage of revenue is being converted into operating profit. This could suggest high operating costs or inefficiencies in the company's operations. Companies with low EBIT margins may struggle with cost control or may face intense competition that drives down prices, affecting their profitability. High EBIT margin. A high EBIT margin signifies that a larger portion of revenue is retained as operating profit, indicating efficient management and lower operating costs relative to revenue. This can reflect strong operational efficiency, effective cost management, or a favorable market position that allows for higher profit margins. How can companies optimize EBIT margin? Improve operational efficiency, streamline processes, and reduce waste to lower operating expenses while maintaining or increasing revenue. Enhance revenue streams. Focus on increasing sales through effective marketing, expanding product lines, or entering new markets to boost revenue without proportionally increasing costs. Cost management. Implement cost control measures to manage and reduce operational expenses, such as negotiating better terms with suppliers or investing in technology to improve productivity. Key takeaways. The EBIT margin is a key indicator of how well a company is managing its core operations relative to its revenue. It helps investors and managers understand the proportion of revenue converted into operating profit. A higher EBIT margin reflects better operational efficiency and cost management. A lower EBIT margin may signal operational issues or high competition impacting profitability. Companies can enhance their EBIT margin by improving efficiency, increasing revenue, and managing costs effectively.